Everyone makes mistakes. However, as a financial planner, I have the privilege and perspective of seeing mistakes from a different angle. And there are some that can be costly, not just for you, but for your kids and your kids' kids. We can call them generational mistakes. So, what are those mistakes and how can you lessen the severity from them? The biggest mistakes that I have seen, not just from investors, but from a financial planner's perspective. Let's go ahead and break it down. I've got 6 that I see, and they're not just investing focused, and they're just from sitting on this side of the table, if you will. The first one, and this one, I think more people are catching on to it, but I do continuously see this. I'm going to show you exactly how, is investing in cash, like still investing in cash. And these are for old investing accounts and even current ones. What do I mean when I say investing in cash? There are a lot of people who have an IRA, they'll have a 401k, and they will put money into it, but not actually click and say, hey, I am investing in a European index fund and that money is growing at 30%. Like it did for the majority of 2025, or I'm investing in an S&P index fund that this year in 2025 grew at like 16%. They will just put it in there and they'll be in like a stable fund or a money market fund and just be completely flat. For example, I'm speaking with clients now and met with someone who their old 401k was sitting in cash for 6 to 7 years. Had he invested that in a regular basic index fund, that could have been $15,000. Instead, it was 3 times less. 3 times less. Could have 15, ended up with just 5 because it was just stuck in cash. That is common. That's not the first time I have seen it. I saw somebody with more than $100,000 and they were doing that for like 20 years. And they're like, hey, I've been doing this. I've been working at this place for, decades. I wish my money was growing more. And I looked down, I'm like, hey, this is all cash. What's going on here? How do you solve this? Well, one thing, when you look at your account, they usually show like a pie chart. If it's all one color, it's usually a sign. Not always, but it's usually a sign that it's all invested in one thing. And if that one thing is cash, that's an issue. But it usually will say, either stocks and bonds, it'll say stable fund, it'll say cash, money market. Those are real indicators that something is up. So you want to take a look at those. You can obviously give me a call, buildingbread.com/call Kev. And just like I did with that person or anybody else, we can sit down, do a screen share, and look at it and make sure that you are in the right place for you. Next one is being too heavy into one type of asset. And when I say that, I am really speaking of real estate and business ownership. Both of these can be extremely powerful. Both of them can be extremely powerful. So I'm not saying don't invest in real estate. I'm definitely not saying don't start a business. Both of them are millionaire makers. All right. However, they can change, right, and be a detriment to you if you don't know how to manage them as you age. For example, I've had people who have been great in their 30s and 40s when they've owned 5, 6, 7, 8 rental properties. And it's easy for them to get up and go and collect rent in all these places. But once they get into their 50s, 60s, 70s, it's not as easy to get up and do all of those things. It's not as easy to find and hire contractors or get out there and paint these houses and cut these yards themselves anymore. And they get tired of doing that. So now they need to figure out, well, do I sell these houses? And it just gets a lot more complex unless they want to hire out for people. And at that age, for some people, not all, but at that age, they don't always want to trust people because like, hey, I've amassed all this stuff. I was managing this stuff for 10 or 15 years. I don't now want to hand over that type of control. Just be aware of that. I'm not saying it's bad. I'm just saying these are mistakes that I've seen. You want to diversify a bit more. Have you, instead of 10 rental properties, maybe 2 or 3. Right, and diversify in other ways. On the business ownership side, again, a great way to grow and build your wealth. However, there are also tons of situations where like, hey, I've owned a family car wash, I've owned a family barbershop, my kids don't want it, my kids can't operate it. How do I get out? Right? Sometimes they're able to sell it to, a private equity firm or something like that. Sometimes, if you have those connections. Other times they can't, and it goes out of business, or they have to work into the end, right? But they get a lot of income out of it. But how do you get out of it, get a lump sum, and retire away where you don't have to work in it every single day? You want to be able to use that cash flow, continue to build up other assets, right? You want to be able to say, hey, I have a plumbing business, I have a painting business, I have a barber shop, and I'm taking that money, making money now, also investing that money, and I'm doing both of these things so that when I'm done with the barbershop and I can sell it or I can let go of it or whatever, I still have these assets to take care of me at the end. I took that and used it to buy a rental property, whatever it is, so that that isn't your constant job that you cannot let go of. But I've seen that happen over and over again where they're not able to sell it or not able to move on. And sometimes they can find a buyer, other times they cannot. But that can be something that you absolutely need to watch out for. This one I talk about every single year around this time. That is making sure your beneficiaries are updated. Do this for yourself. Do it for me. Do this for me. I say that because should something happen to you and I gotta explain who you left on that beneficiary form, it makes for very awkward conversations. And you know, if it is your ex-spouse and I'm talking to your current spouse, I've had these conversations. These are mistakes, right? These are mistakes that other people have made, and it makes it real awkward. Don't do this to me, man. Don't I don't want these conversations no more. Now, again, in my case, every time I bring this up, these were my first conversations with these people, because in my previous experiences, you know, you're a new advisor taking over a branch, so you're a lot of times you're meeting these people for the first time and you're reviewing all these things like, hey, such and such passed, or we are just at this branch today and this happened, so we're, you know, coming in trying to fix all this stuff. And you sitting here looking at the current spouse, I'm making up a name here, you're like, who is Susan? And Susan ain't in there, so that's the ex-wife. And you're like, oof, awkward. So please don't do this to me. Make sure that your beneficiaries are absolutely updated every single year, and that includes expanding the family as well. This one I'm seeing cost people in more ways than one. That's being too sentimental around a specific stock, and this one cost me specifically. When my son was born, I bought him shares of Nike. Now I let Nike go. We talked about when I let Nike go years ago, at least maybe 3 years ago at this point in time. Now I continuously talk trash about Nike and the shares. Maybe it will come back. If I talk trash enough about it, maybe the stock will come back. But Nike was one of my son's very first stocks. However, I kind of held on to it because I was like, hey, it's my son's first stock. I kind of want him to hold on to it forever and ever and ever. And it ain't really worth it. It is not worth. It's not like I truly own the whole company. Like I have a key to the front office. Let it go. And I have had people hold on to shares of a stock that was passed on from a parent, and I understand that there is an emotional connection there. Dad left me shares of IBM. Dad left me shares of ExxonMobil. Grandpa left me shares of Berkshire Hathaway. Now, Berkshire Hathaway might actually be worth something. IBM might actually be worth something. But there are some cases where those shares aren't worth anything, and it's just consistently losing you money. What I would recommend sometimes in those cases is, let's take some of that off the table where it's not weighing down your entire portfolio. I'm not saying get rid of it and just say, hey, you know, forget grandpa, it's not going to work. I would say, look, let's just reduce it to where it's like one portion, or you just have one share left, depending on how much it is. So it's not just, you know, you're not losing everything. So you still have that memory, you still have that piece of it, but it's not throwing off your entire returns. I think grandpa left you those shares because he probably thought they were going to be good, and there's no way that person would imagine that the economy would change in a way where that stock wouldn't be good anymore. And if they were still here, they may have sold it as well. So I think that's extremely important. It's a tough conversation to have, and to get that emotional pull is why we buy certain things. And the objective is that you are in a better place, and you're not doing that by holding on to an inanimate stock, right, of, you know, weighing you down. So again, I'm not telling you have to get rid of it all and just scrub your entire portfolio, but just trim it down to a spot where it's not going to hurt you if, and that's only if, that stock just isn't doing well at all. Another thing I see people ignore from a financial planner's perspective is the tax side of things. And one is an overestimation of taxes, but also the tax diversification part of this. Now, I did mention this a little bit in a previous video. I have gone into detail of how this works in another video, and I'll link that here at the end. But a lot of times we completely ignore this. And what I mean by this is tax diversification in. There are three distinct buckets when we talk about taxes. Now, a lot of times, especially if you're scrolling online, the most popular things people talk about is either one, Roth IRA. You need a Roth IRA, you need a Roth IRA, and that's everything that people talk about. And that's fine. Roth IRAs are good. And then you hear people talking about 401ks. Everybody needs a 401k. If you got one, get the match, so on and so forth. And that's also good, right? If one is provided unto you, I'm all fine with taking that. However, you need all three if possible, right? And what I tell people is that there is a taxable bucket, a tax deferred bucket, and a tax free bucket. Having all three, that is the key to really building wealth, and it's going to give you a lot of flexibility down the line. What do I mean by that, and how do I mean that? Number one, that taxable bucket is underrated, absolutely underrated, and completely missing that is how people get tripped up. For example, if you were to experience a layoff, if you are trying to buy a home, what some people end up doing is withdrawing from one of those retirement accounts early, and that's going to cause a tax penalty in some cases. I say in some cases because you can withdraw from an IRA, a Roth IRA rather, and if it is the contribution, then you do that without a penalty. But doing so, those are retirement funds. You want to keep that for as long as you can. However, if it's a taxable account, which means I could put in as much money, take out as much money with no penalty, you good to go. People in the FIRE movement, financial independence, retire early, how are they doing that? A lot of them, not all, but a lot of them do so by investing in that taxable account. That is number one. Now, you're going to be taxed on it every year, but the fact that I can just overload that, put as much money as I can and withdraw as much as I can whenever I want to is extremely important. So that's number one. Then I have the tax deferred bucket. That's my 401k. That's my traditional IRA. I ain't been taxed on it now. I'm getting to lower my taxes now, put what I can in now, whatever the limit is by the time you're watching this, because they do change. And then I got the tax free, right? That is my Roth. My Roth 401k, my Roth IRA. Getting taxed today, put money in, I'm able to withdraw it at 59.5 tax free. Having all three allows me to have access now with my taxable, allow my deferred taxes to continue to go, and then once the first taxable bucket is out, then I can do tax deferred. Then once that's out, I get my tax free at the very end. And in theory, the way that this will work is I get all of my money and it grows the most efficiently for me. But if I got it all in my Roth, which I mean, it's not the worst case scenario, but I'm not really playing my cards the best way possible because I would have to wait until 59.5 for all that to happen. What if I want my money sooner than that? Then what? Right? What if I want my money to grow even more than what it is in a Roth? If that's the case, then my tax deferred bucket comes in handy because I can start to pull from that at 59.5 and my tax free bucket can last me until 60 or 65. Look at that, right? That's a mistake if I put everything in a Roth and not pay attention to nothing else. And you get to learn from all of these different perspectives. And if you're somebody who likes to learn from those different perspectives and like to incorporate that into your plan, then you would enjoy signing up for a call at buildingbread.com/callkev. So that link is below. My calendar is starting to fill up for 2026. Would love to talk to you one-on-one to help you to build a plan. If you want to know more about the stock market, investing, and everything in between, you want to check out this video right here.